series on Unleash Your Potential and Learn Upskill Excel. This series is one of Women and Young Members Excellence Committee's initiative to augment the presently working in industry, corporate, but aiming to switch to practice. Members who are on the career break but want to resume their professional career, or members aiming to widen their area of expertise in the respective professional domain. This series will also be helpful for members at large in enriching their knowledge and overall confidence building by keeping them abreast with the latest amendments in diverse fields. Today we are going to cover session on income tax returns, international and related income tax utility and filing, uploading of return, verification with 26 AS and AIS, revised return, updating of return, processing of return, DSC, verification of returns, rectification communication with CPC, deemed verification portal, and communication with demand verification unit. Refund, request to issue refund, change of bank account. Today we have CA Namrata Dedia, who is going to deliberate the lecture on this particular subject. She is one of the fantastic lady having the much expertise in the area of which today we are going to have the session. First of all, before I introduce Ms. Namrata Dedia ji, I would like to introduce her by giving a brief profile. Madam Namrata Dedia ji is by qualification is BCom FCA, and she is practicing as a partner of Shah Dedia and Associate in the area of direct tax, FEMA, transfer pricing, and cross-border taxation. She specializes in transfer pricing and international taxation. She has advised clients, including startups, on the structuring of investments, tax and transfer pricing implications of the same, developing transfer pricing policy and regulatory requirements under income tax and FEMA. She is graduated from Arya Podar College of Commerce and Economics. She qualified as a chartered accountant with 17th All India rank at CA final exam and 7th All India rank at CA PE1 exam. She has also secured 4th All India rank at CS final examination and 23rd All India rank at CS foundation exam. She has spoken at different forums on topics relating to transfer pricing, FEMA, and taxation, and also contributed articles of professional interest to journals and newsletters. She is a member of the International Taxation Committee and Research and Publication Committee of the CTC. With this, without taking much time, I would love to call Namrata Dedia ma'am in front of you, who is having with detailed discussion on the content for which we all are sitting here and waiting eagerly to attend the program. Welcome, ma'am. We welcome you with hand folded. You have spared your valuable time and here to impart the knowledge among the members. Hats off to you, ma'am. Thank you so much.
Thank you, Rituji. Thank you for the warm welcome. It is a pleasure. I heard about the exact description of this series that you have initiated, and it is a very good initiative that the WMEC has taken for encouraging women and young members to start their own practice if they wish to do so, by giving them a glimpse of various areas. Of course, we all are learners and we keep learning in practice always with new things coming up, but it's a good way to at least give them a starting point. I appreciate the efforts taken by your committee for this. Without taking much time, since we have about an hour to start this topic. To cover this topic, I'll share my screen. I hope my screen is visible.
Yes, ma'am, it is visible.
Yeah, thank you. So the topic for today is income tax returns, intimations, and refunds. This compared to the earlier topics in the series of direct tax that I have seen in the schedule. This topic is more of the actual execution of filing of returns, of selecting the correct return form, of how the returns get processed, if at all there are issues in the processing, how to deal with them, what happens for refund processing, if there is a demand, how should we deal with them. So it's a gist or an overview of the actual implementation of all the technical knowledge. So this session is less about the technical discussion of the provisions of the act or the rules, etc., but more about the navigation of the income tax portal. Of course, at the end of the day, it is an income tax portal. Once you log in, you look for different options on the portal itself. You will figure out how things work eventually. But the idea is to give a broad overview of what all are the processes involved when we are filing the income tax return and after that. So broadly, what we are going to cover is the how we should be preparing for and filing the income tax return, the process for that, the intimation and refunds relating once the returns are processed, what are the broad scenarios where we are looking at filing revised return, updated return, or even rectification of an existing return. And finally, the CPC, the Demand Facilitation Center, which is basically the other end of the portal, with whom we are supposed to be interacting. So when it comes to preparation and filing of income tax return, the first point that we ought to discuss, the first starting point, is to understand the income tax forms. We have 7 income tax forms that are applicable based on different conditions, based on the type of the assessee, based on the nature of income of that assessee, based on sometimes even the quantum of the income. And my understanding is right now we are discussing, or our focus is more on the upcoming tax filing season of 31st July, primarily individual income tax return filing, as we call it, or non-audit cases. Let me put it that way. And therefore, I have spoken about ITR 1 to 4, which are the forms that are relevant to the non-audit cases. We have ITR 5, 6, and 7 also, 5 and 6 being applicable for audit cases, for company cases respectively, and 7 being applicable for all cases where there is a tax holiday on account of the entity being a trust or a medical institution, educational institution, etc. So those are the other 3 forms. ITR 1 to 4 have already been notified, even though the tax filing technically should begin only after 1st of April. ITR 1 to 4 have already been notified in February 2023, with the intention of the government being that if the ITR is notified that early, then it gives sufficient time to the taxpayers to prepare for their return filing. And therefore, there should not be any need to extend the deadlines as happens year on year because of some or the other issues, because of excessive delays in the TDS certificates or the TDS reflecting in 26AS, etc. So the government has this year, or the CBDT rather, has notified ITR 1 to 4 in February itself. Of course, notifying ITR itself is not sufficient, because when they notify ITR, they are giving only a PDF format in the notification that this is how the forms will look like. So what it does help the taxpayers with is it gives them an idea of which ITR will apply to them and what are the requirements, disclosures to be done in that ITR, so they can start preparing for documents accordingly. But the practical reality is that that itself is not sufficient to speeden the filing process. We need one, the utilities from the port to be made available. Two, we need also TDS certificates, etc. The all the information which gets disclosed in ITR, in AIS and 26AS to be complete to be able to file the ITRs. So the very common thing is the TDS returns for Q4, that is Jan to March 2023. The deadline for filing the TDS returns is yet to pass. 31st May is the deadline for filing of TDS returns for Q4, post which TDS certificates get generated, the information gets reflected in 26AS and AIS, which means till my deductor has filed the return for the TDS return for Q4, the information of the TDS will not reflect in my 26AS and AIS, and therefore I will be unable to file my return of income for multiple reasons. One, I may not be aware of the exact TDS, such as in case of bank interest. Two, even if I'm aware of the exact TDS, unless and until that information reflects in 26AS and AIS, I will have a mismatch when my return is processed. So for these reasons, for these practical reasons, even though the ITR forms have been notified early, effectively what happens is we need the filing season will be mid-June onwards, primarily mid-June onwards. Only in exceptional cases where TDS information is not pending, not required, not applicable, will you be able to file the ITR forms early. Nevertheless, at least the details or the format of the ITRs is available, which helps you to prepare to gather information. So that's a start to finish the work on time. Now, the Excel utility of ITRs 1, 2, and 4 are already available, but the JSON utility is not yet available for any of the forms. So these two, the Excel utility and the JSON utility, are utilities already available through the income tax portal itself. And then the income tax portal or the income tax department also releases a schema for all these forms, which helps third-party software providers to incorporate the same ITR structures in their softwares, and we can use those softwares to file the returns. So either we use the free utilities which are made available by the income tax department itself, or we use paid softwares which are based on these schemas. Compared to the earlier years, if we have to discuss what has changed in this year's ITR forms, the major change is regarding disclosure of virtual digital assets. So one of the major changes in last year's budget was the taxation of virtual digital assets. This is the terminology used under the tax provisions. If I have to use a layman's language, it is nothing but crypto assets that we are talking about. NFTs, maybe if somebody has dealt with in that. So in assets like crypto, NFT, etc., till last year or before budget 2022, there was no clarity on the taxation, and therefore everybody chose to tax it the way they saw fit. Last year's budget introduced the norms for taxation of the virtual digital assets and said that no expense will be allowed in the taxation of the virtual digital assets. So now that this asset category is being recognized by the income tax law, the return forms require a separate disclosure for this asset category to be made in the form. So that is one of the major changes if we have to compare the return forms for assessment year 23-24 with the earlier years. So what are which forms? ITR 1, 2, 3, 4, I said which form will apply in what situation. The information is already nicely captured on the income tax portal itself, which I have used here in the presentation for our discussion purposes. So ITR 1, also nicknamed as Sahaj, is applicable in cases of individuals. What kind of individuals? It is applicable only for resident individuals. Resident and ordinary resident individuals, which means if you are a not ordinary resident, if you are a non-resident, then in that case, you cannot file ITR 1. Additionally, we'll have to look at the other ITRs. We'll come to them. Additionally, this return applies for resident individuals having total income from any of the sources mentioned up to rupees 50 lakhs. So if the total income exceeds 50 lakhs, then again, the individual will not fall under ITR 1. We'll have to look at the other ITRs. What all incomes are covered in this ITR? Salary income or pension income. House property, that is only one income from one house property. You cannot have income from multiple house properties. Then other source income such as interest, family pension, dividend, etc. And if you have agricultural income up to rupees 5,000 only in these cases, ITR 1 can apply. So if you have business income, capital gains income, ITR 1 cannot apply. If you have more than one house property, ITR 1 cannot apply. So all of those cases will fall under the other ITRs. Also, ITR 1 will not apply. Look at the note below. The ITR 1 will not apply in case of a person who's a director, a person who has any unlisted equity shares during any time of the year. It may be sold at the end of the year, but if at any time during the year you have held unlisted equity shares, then again ITR 1 cannot apply. If you have any asset outside India or signing authority in any account outside India or any source of income from outside India, then in all those cases, ITR 1 cannot apply. If tax has been deducted at source under 194N, again ITR 1 cannot apply. If there has been any payment or deduction of tax which is deferred on ESOPs, which is for eligible startups, payment of tax on ESOPs for eligible startups has been allowed to be deferred considering the cash impact of those. And if that is the option that has been taken, then again ITR 1 cannot apply. Or if there is any brought forward loss or carried forward loss under any of the head of income, then again ITR 1 cannot apply. So essentially, what we are saying is ITR 1 will apply in the simplest of the simple cases. If you look at the ITR forms, you will understand that all these extra criteria of being a director in a company or holding unlisted equity shares or assets outside India have separate schedules in the ITR form, each of which requires disclosure. If you're a director, give details of the company in which you are a director. If you hold unlisted equity shares, give details of the name of the company, how many shares, cost at which it was acquired, etc. If you have asset or signing authority in any account outside India, then you have to give details of those assets outside India. So all of these criteria have separate disclosures under various schedules in the ITR. ITR 1 is a simple, very limited income, dealing with very limited income form, which means it will not apply if any of these complexities come in. Then you have to look at other ITR forms. So what are these other ITR forms? We have ITR 2, ITR 3, both of which are applicable for both individuals and HUF. ITR 2 is essentially the ITR that will apply if that individual is not eligible for ITR 1 and still he does not have business income or income under the head profits and gains of business or profession. So let's go back, which means ITR 1 will apply if you have capital gains income, because that is the category missing here. It will apply if the individual is a not ordinary resident or non-resident, because that is a criteria that is missing here. It will apply if the total income exceeds 50 lakhs. It will apply if the person is a director, has unlisted equity shares, has asset outside India, etc., etc., etc. So any condition meant for ITR 1, not satisfied, but the person is an individual or an HUF, does not have business income, ITR 2, has business income, ITR 3, right? So ITR 3 is same scenario, individual HUF having business income, but who does not fall under ITR 1, 2, and 4. So basically for ITR 3, you have to eliminate ITR 1, ITR 2, and ITR 4. Elimination of ITR 1, we have already seen the conditions. ITR 2 will get eliminated if you have any form of business income. So ITR 2 already automatically goes out. ITR 4, what are the requirements for ITR 4? ITR 4 is nicknamed as SUGAM, also known as SUGAM. Applies for individuals, HUF, and a firm other than LLP. Mind you, taxation of firms and LLPs is identical under the Income Tax Act. A firm is defined to include an LLP. But when it comes to the ITR form, the ITR 4 is available to firms, but not available to LLPs. Right? So, what is ITR 4? Who can fall under ITR 4? It can be individual or HUF who is a resident, but not ordinary, not other than not ordinary resident, which means resident and ordinary resident is the category we are talking about. Firm other than LLP, resident having total income up to 50 lakhs, and having business income from business or profession, which is computed on a presumptive basis. So only and only if you have income from business or profession, which is calculated on a presumptive basis, that is, it falls under 44 AD, ADA, AE, and income from any of the following sources, then you will get covered. What are the other sources that we're talking about? Salary and pension, one house property, other source income, agricultural income up to 5,000. So if you notice, ITR 4 is ITR 1 plus something, plus two things additional. What are those two things additional? One, ITR 1 did not cover HUF or firms. ITR 4 covers HUF and firm. Second, ITR 1 did not cover any income from business or profession. ITR 4 covers income from business or profession, which is computed on a presumptive basis only. Everything else under ITR 1 and 4 is same. You need residential status to be resident and ordinary resident under both these forms. You need income to be up to 50 lakhs under both these forms. And you are covering what other income? Salary, pension, one house property, other source income, and agricultural income up to 5,000. If any of these conditions are not met, then you will go to ITR 3, as we discussed now. Also, the same restrictions that apply to ITR 1 apply here also, which is the person cannot be a director in a company, should not hold unlisted equity shares, should not have any asset outside India, no signing authority outside India, etc., etc. The same conditions apply, which means this is exactly similar to ITR 1. The idea of Sahaj and Sugam, in fact, is to simplify tax filing for a large majority of the taxpayers. That is why, where the computation of income of those people is very simplistic, then ITR 1 and 4 will apply, which are very, very short forms. I hope that is clear. Then we come to the filing. So these are, we understood how the 4 forms will apply and how we will choose which form applies in what cases. Of course, if you are using any paid softwares, the paid software will assist you to choose the forms. Even the utilities provided by the income tax department have the functionality to assist you to choose the correct income tax form after asking you certain questions. So that is also possible. So filing of the form can happen, or filing of the return can happen online or offline. So since the last 2 years, income tax forms can now be filed online through the portal itself, which means you log into the portal with your login details. You say you want to file the form online, and once you select the online filing option, certain data will be pre-filled. Your PAN, your name, etc. will be pre-filled. other information you will have to fill, and through the portal itself, you can upload. Now, this can be a time consuming process. So that is why the portal has the functionality of saving the draft. That saved draft, you can, if you are stuck anywhere, if you have some missing information, you can save the draft and leave it. And then you can resume the filing subsequently at a later date whenever you have that information, with a time limit, of course. If 30 days have passed, or if the return filing deadline or the return is already filed, then in that case, the draft will no longer be available. So other than that, the draft can be accessed and you can continue the filing process. That is online filing. However, what this needs is for all information to be readily available with you. Also, what it needs is proper connectivity at all times. So while in the current timing, this connectivity may not be an issue, but we have always experienced that towards the end, where we are approaching the tax filing due dates, the load on the portal increases significantly, and there at that point of time, the connectivity becomes an issue. So in those scenarios, online filing may be a little difficult to handle if the portal does not respond correctly and in a timely manner. So what is the alternative? The alternative is offline filing. There are utilities provided by the income tax portal itself, like we discussed, an Excel utility, a JSON utility, and you can also use third-party softwares. So the Excel utility, the name itself suggests, is a utility created in Excel. It's a macro-based Excel that is created to capture all the information relevant for that ITR form. Each ITR form has a different Excel utility, and you fill the data in that Excel utility, upload it to the portal. You can also import certain pre-filled data and complete the Excel utility, generate a JSON file for filing the return. So both these utilities as well as the third-party softwares will all help you to generate a JSON file, which eventually will get uploaded on the income tax return to complete the return filing process. Now, the difficulty with Excel utility, if you happen to download the Excel utility and see the utility, is you will understand that it is, in terms of feeding information, in terms of data entry, it is less user friendly as compared to the other options, which is the JSON utility and which is especially third-party softwares. The third-party softwares are quite more user friendly when it comes to putting in information in the software, and the JSON utility getting generated through the algorithm of the software itself. Also, with Excel utility and JSON utility, the problem that arises if you are filing returns for the same client repetitively is that every year you will have to start afresh. Every year there will be a different utility. You will have to download those fresh utilities. You will have to fill in information in those utilities again. Even the static information such as address, such as ownership of shares, ownership, directorships, etc., which may not change every year. Bank account details do not change every year. Even those information you will have to fill every year into the Excel or the JSON utilities during the return filing process. So that becomes duplicative work. Even not just that, if in the middle of the from today till the due date of filing, if the income tax department comes up with new schema of these forms, which means the underlying form structure is changed. There are minor changes made to the form. Maybe something is added, a line here, a line there is reduced. Some changes are made to the structure of the form because of which the schema changes. Then the utility or the JSON, Excel or the JSON utility that you're already using will become useless. You will then have to fill all that information again in the fresh utility, in the new utility that you will have to download from the income tax portal. So if you have started filling a utility today, some information is missing. You ask the client to give that information. The client takes 15 days to give that information. And in between those 15 days, the schema changes. Then you have to again download a new utility and start filling it. So all of these factors, this will be true even for online filing. If you have saved a draft and the schema changes, then again your draft will be lost. You will have to start filling again. So all of these factors make the options of online filing, Excel utility and JSON utility little less user friendly. As against this, what will happen in third-party software? There are so many third-party softwares available for return filing. What happens in those cases is whatever static data you have filled in the returns will be carried forward year on year unless there is a change, you can specifically change it. So details like bank account, directorships, listed, unlisted shares held, everything will get carried forward. If at all there is any linkage to any previous year data, that will also get absorbed. So details of brought forward losses, etc., will automatically get taken, pulled in the third-party softwares, which otherwise in the Excel utility and the JSON utility, you will have to fill. So plus, if there is any schema change, you don't have to start work from zero. The software will continue to hold the data that you have filled in. At the back end, they, based on the schema, they will make changes to the process of generating the form, the JSON file, and capturing information, etc. So if there is any added information that is required, you will need to fill that added information. But you will not have to start from zero. You will not have to start from scratch. You can build on the data that is already filled in the software. The software will take up the responsibility of changing the schema in there, or making the changes as per the schema in the software. So that way, this becomes very user friendly. Also, JSON utility is a common utility for ITR 1 to 4. Excel utilities are separate utilities. One of the most important things of when you start filing a return, you will gather all information for each head of income, gather relevant documents. So salary income, get form 16, pay, get TDS certificate, which is form 16. Of course, also get part B, etc., which gives the breakup of the salary. Then get proof relating to the deductions which are being claimed by the assessee. You gather all information relating to each head of income from the client and accordingly prepare the return data. But two of the most important things also to be done, without which your return preparation is not complete, is to verify the data with 26AS and AIS. These are the informations available with the income tax department through various sources, which are connected to the PAN of your client, which are linked to the PAN of your client. So before you finalize the return, before you file the return, make sure that you have verified all information from the data available in 26AS and AIS. So what is 26AS and AIS? I'm sure last 2 years, all this is prevalent. Everybody would have gone through, but just to touch upon, 26AS basically primarily gives details of all or any income which is reported by the tax deductor, on which tax has been deducted, or sometimes tax may not be deducted, but it is still reported in their return statement, in their TDS or TCS return statement. So if I am receiving any professional income, any interest income, any dividend income, any contractual income on which TDS is deducted before making a payment to me, then all of that will show up in the 26AS. I said sometimes even if no taxes deducted, amounts are shown. So that happens mostly in case of dividends which are declared by listed companies. So what listed companies do is when they are filing these returns, TDS returns, they will not sit and segregate dividends on which TDS is deducted, on which TDS is not deducted. They will just auto-populate the information of all dividends paid out by them against the PAN of the shareholder and file that in the returns that they file, TDS returns that they file. So the dividend information can reflect for some listed companies which have just filed everybody's information, even if there is no tax that is deducted on that dividend income. Then, if you have income which is otherwise liable to TDS, but for which you have filed Form 15G or 15H, such as bank interest income, senior citizens receiving bank interest income, if they have no other source of income and the bank interest income is maybe about 2.5, 3 lakhs, 4 lakhs, on which finally there will be no tax liability, they will file 15H with the banks. Now, in that case, ideally, if the interest income is, let's say, 2.5 lakhs, then TDS is deductible. But because of Form 15H, the bank will not deduct TDS. Now, that information also the bank is supposed to file, and that reflects in 26AS. Then, what also shows in 26AS is TCS information. If TCS has been done when you have made any payment, such as foreign remittances, if you make foreign remittance and on that foreign remittance, the bank has collected TCS, then that will reflect in 26AS. Sorry, refunds that are paid will reflect in 26AS. My experience has been in the recent years, this information of refund paid is not very accurate. There are times when refund is received, but still it does not show in 26AS. So we have to be a little careful on that information. Then if there are any TDS done by the buyer of a property, tenant of a property, then that shows in the 26AS of the buyer himself. So for example, if I am buying a property, I am required to deduct TDS at 1% from the seller of the property and deposit it to his credit. It will show in the 26AS of the seller, but it also shows in 26AS of the buyer. So in such cases, we have to be careful not to claim the TDS in the return of the buyer. It is not a tax paid to the credit of the buyer. It is just a transaction done by the buyer on which the buyer has deducted tax for the other party and paid it to the credit of the other party. So we have to be careful where we are picking information from. If you're using third-party softwares, the softwares will automatically pull data from 26AS. They'll import data from 26AS. They will automatically import the data that is relevant and leave out such information. But if we are filling in information in the utilities, we have to be careful that TDS, which is done by a buyer of a property or tenant of a property or person who is making a payment, will also show in 26AS, but they are not to be claimed credit for in the return. Then advanced tax, essay tax details will be shown in the, details of tax paid such as advanced tax and essay tax used to be shown in 26AS, but that information is, that table is now being removed. Then any TDS, TCS defaults in case of the assessee in their filings will also show in 26AS. We now have, so earlier till 2 years ago, we all relied only on 26AS for this information. But the problem with 26AS is it did not reflect a lot of the information. It did not reflect items on which or incomes on which no TDS has been deducted because it was below a certain threshold. It did not reflect financial transactions. Now, all of that is being captured in AIS. So AIS can be accessed through the compliance portal. It can be downloaded as a PDF and an Excel both. While the Excel is useful for making calculations, the Excel is useful for maybe copy pasting data and maybe importing information if required. I have personally more comfort on the PDF as a source of information, because a lot of information that reflects in the PDF does not show in the Excel. And therefore, my team may use Excel to import data or to copy paste data, but the final verification that I do is from the PDF only. What all information is captured in the AIS? Again, a lot of it is overlapping with 26AS, but a lot of it is not. So, sorry, any TDS, TCS information will show here, which was already there in 26AS. Dividends, interest on FDs, etc. will show. So all those dividends and interest on FDs on which TDS is deducted will overlap. But there will also be interest on savings account. Now, interest on savings account does not attract TDS and therefore it never shows in 26AS. but it will show in AIS. This helps in knowing how many bank accounts the taxpayer has. Earlier, with 26 years information, there was no way of knowing if the client has given us details of all bank accounts or not. There are instances, there are many instances of clients not giving information of all their bank accounts, thinking that a certain bank account will never get traced. There is no need to share information of that bank account. But now with AIS, we are able to find the details of all bank accounts in which are linked to the PAN of that particular taxpayer or the client that we are preparing the return for. So that gives us information, helps us to prepare a more complete or a comprehensive return. Then purchase and sale of mutual funds, shares and securities, all of that reflects in AIS. It may not have anything to do with income calculation. You may have only purchases of mutual funds, only purchases of shares, but it will still reflect in AIS. It gives you an idea of what are the nature of transactions happening. It gives the tax department, more importantly, an idea of what are the volume of such transactions happening and whether there could be a situation of underreporting of income. For instance, a person files a return every year with a income of, let's say, only 2-3 lakhs, 4 lakhs, does not pay any taxes, but that person has purchased mutual fund worth 50 lakh rupees or 1 crore rupees. Now the tax department is obviously going to find it difficult to digest that a person who has hardly any income, does not pay taxes, is able to purchase mutual funds worth of 1 crore rupees. So those are informations which are analyzed and notices are sent to the taxpayers based on these kind of information. Then tax paid details, advanced tax, estate tax will reflect in AIS. It used to earlier show in 26 years. It doesn't show there, but it shows in AIS. Details of any outstanding demand, refund, etc. will all show in AIS. Also, other information such as fixed deposit, which is created with banks, purchase or sale of property, etc., are also shown in AIS. So all of this information helps both the return preparer, which is us professionals, to make sure that all bases are covered. And it also helps the tax department to analyze the information of investments, purchases, sales, etc., vis-a-vis the value or the incomes that are being declared in the return of income. In certain situations, my experience with AIS also has been that sometimes, even though some information is showing in 26 AIS, not all of that reflects in AIS. It may be a technical issue, it may be improper reporting by the other person, I'm not very sure. But let's say bank interest. So Q1 is skipped, and then you have Q2, Q3, Q4, which are showing correctly. So sometimes something of that sort happens. So basically, you can't say because AIS is everything, I will ignore 26 AS. You have to marry both. You have to look at 26 AS, you have to look at AIS, gather information from all sources, tie it up with and match it with the information that is given to you by your client and make sure that everything is covered. If not, the client is highly likely to receive notices for any mismatch in future and will come back to you asking for help in dealing with those transactions. So it is better to review all information from 26 AS and AIS and make sure that everything that has any impact on the income calculation is covered, is correctly reflected. The process of filing and uploading of return, fairly simple process actually. I wasn't even sure what I should write here in the slide. When you go to the income tax portal, you realize you have to select the option of filing the return. It will ask you what is the year for which you want to file, what is the form type, etc. and take you through the process. Upload whichever, whether you use the utility or the software, the JSON file is generated. So upload that JSON file, go through the process. You keep doing taking the next step, and it takes you through two aspects. One, if there is a tax liability which is to be paid, or rather there is a tax due. So the portal will give you the option of pay now or pay later. Pay now means either you've already paid, you upload the challan or give the challan details. If not, then you can also make the payment as a part of that process. This is especially if you are using the JSON utility or you are doing the online filing. In those cases, you will have this option. If you say pay later, then you have to be careful not to make the tax payment beyond the due date. Otherwise, the return can be treated as invalid. So the payment for taxes earlier, there were options of paying through the PIN NSDL portal, or even many of the banks on their net banking page give the option of tax payments. So those options still exist. Now we have option of tax payment also on the income tax portal. So the income tax portal gives you link for tax payment. If you make tax payment through that portal, then you have to make sure that it takes about 2 to 3 days for the payment to be processed and to reflect. So after 2 to 3 days of making the payment, make sure that you have that information is correctly reflecting in the portal, and it will have to be linked to the return or whatever form you have filed. So if you are going to use this payment mechanism, you have to make that payment at least 2-3 days before the filing so that it is reflected and linked correctly. Now, once you have filed the return, the process is still not complete. The return that is filed has to be verified, and the verification has to be done within 30 days of filing. Earlier, it used to be 120 days of filing. Last year, that was changed and reduced to 30 days of filing. Now, how do you do verification? There are 3 options. Once you file the return, acknowledgement in the form of ITR-V is generated. So either you do physical verification, submit that signed ITR-V to CPC Bangalore. You should not be couriering it. That's not an acceptable way. In fact, the ITR-V has those instructions. So you will always find those instructions. But just as a matter of caution, courier is not an accepted way of sending that signed ITR-V. You have to send it by post only. If you are not keen on physical verification, ideally physical verification should be the last resort, because all other options give you immediate verification, immediate confirmation, and the process gets over. You are aware that the process is over. If you are sending a physically signed ITR-V to the CPC, you are not sure whether it has reached, not reached, what is the status, if it has got lost somewhere. So those issues are avoided if you do online verification. If you happen to have a DSC, the taxpayer, the client happens to have a DSC for whatever reasons, then the digital signature can be registered on the income tax portal and return can be filed using digital signature. So the return filing process comes to an end immediately. Or the third option is e-verification. E-verification can happen through codes which are generated through different mechanisms. It can be an Aadhaar-based OTP. It can be codes which are generated through net banking, through DMAT. It can be an OTP or a EDC which is sent on a mobile number linked to the bank account. So there are different options which are provided for generating the OTP or the e-verification code, which can be then put in on the portal and the process is completed. Only when verification is completed can you say that the return is filed successfully. A return without verification will get rejected or will become invalid rather once the 30-day time period lapses. If for any reason, if for any genuine reason the e-verification process could not be completed or the return could not be verified, then there is also an option for condonation on the website available, but the option says it is condonation request for delay in submission of ITR-V. So to my mind, it is not meant for online verification. It is meant for physical verification. If any of the options of online verification, whether digital signature, whether OTP codes, anything does not apply to you, and you are forced to do a physical verification, then you could explain the delay and request for condonation of that delay through the portal again. Once the return is filed, the processing of the return, the intimation, the refunds, etc. is the next step. Only when the processing of the return starts from the CPC side, only after it is verified. Till you have not verified, it will not be touched, it will not be looked at. Till you have not verified for CPC, the return is as good as not filed. So you have to verify, only then the processing starts. Now, when it is processed, there could be different scenarios that could come up. You could have a defective return notice that is sent to you, 139.9 notice. If the return misses something, let's say it's a return for a firm and balance sheet P&L should be maintained, but it is not filed, then you could have a defective return which is received, a notice which is received. So 139.9 gives you scenarios where a return can be treated as defective. And if any of those cases happen, then a defective return notice can come. You will be given a certain timeline, usually 7 days, 10 days, to respond to that notice, which effectively means whatever is the reason for defect, you have to cure that defect. You have to file the return again after removing that defect, and the return can then be processed. Also, sometimes we have observed that when the return is processed, in certain situations, there is a difference in the interest calculation. And this is not just manual calculation, this is the difference that we have seen in the calculation as per the softwares and as per income tax portal. Now, in most cases, what happens is that difference in interest of calculation, the 234BC interest calculation, is very nominal, maybe 200 rupees or 500 rupees. So in the whole scheme of things, it does not make sense to pursue that difference and get it resolved, even though we have cross-checked and verified the calculation ourselves. But it is not material enough, and therefore we often just pay it off, close it. But my understanding is it happens largely in those cases where there is capital gains and dividend income. If it is significant enough, of course, it can be pursued. Rectification request can be put in for that. To understand what is the issue, reprocessing request can be put in, and we can see what is how it can be resolved. So, if everything in the ITR is all right, an intimation under section 143(1) will be sent to you by email. If there is any old outstanding demand for earlier years, then the intimation will be also followed by notice for adjustment under 245. The notice will say that you have an outstanding demand, and if there is any refund in your current return, then that refund will be proposed to be adjusted against that old demand. Even if that is not happening. So in those cases, what is important is that you should respond that you are not okay with the demand being adjusted. You can resolve the demand separately. The refund can be kept separate. If you respond to that 245 notice immediately, then the demand adjustment will not take place. If in your client, you had filed for a refund return, a return expecting a refund, and the return that is processed, the 143(1) intimation also mentions a refund, it is always a good practice to check if there are any mismatches. If the return is processed as filed, that is whatever was the refund claimed by you, the same refund is processed, or are there any mismatches, TDS mismatch, income mismatch, which has resulted in a lower refund. There can be some situations where some TDS that is appearing in your 26AS is not correctly processed, or the TDS was appearing in your 26AS when you filed the return, but it has then been removed by the tax deductor for XYZ reasons. You may want to know why it has been removed. If it is removed incorrectly, you may want to follow up with the tax deductor to give you the correct credit of the TDS. So all of those issues, you should check all your intimations, make it a practice to make sure that to compare it with the return file, make sure that whatever is filed is processed. Otherwise, if there is any mismatch which you think is not correct, then you can always take action on that. A lot of times we've experienced that there is a delay in processing that is not explained. We are not sure why the return keeps showing, the progress of the return keeps showing as under process. but we have no clue as to why it is still under process, why it takes sometimes months that it is not completely processed, and whatever is the final action, refund, demand, etc., nothing is done. So in those cases, you can raise a grievance. Of course, grievances are not always leading to the final resolution, but it may help to push to get a resolution. You can also check if there is any old outstanding demand which was proposed to be adjusted under 245. If that be the scenario, sometimes if because of old outstanding demand which is proposed to be adjusted, the processing of the current return also shows as under process. It does not close the processing. When it comes to refund, like I mentioned just now, sometimes the process gets delayed. We hear of cases where people get refunds within 2 or 3 days of filing the return. And then there are practical realities where refunds are stuck for 2 to 3 months, 4 months sometimes, because the return is simply not processed. So there is no fixed timeline. It can be as less as 2-3 days, like I said, or it can even go higher if the return is stuck for some reason. One aspect to be checked when a refund is processed is the interest calculation under 244A. If the refund is resulting from excess SA tax paid by you, you will not be entitled for any 244A interest. But if it is resulting from excess TDS deducted, excess advance tax, then you will be entitled to a interest on that refund under 244A. When it comes to processing of refund, it is important. Now, refunds are processed directly into the bank account. So first, actually, I have not mentioned one thing here. The first most important step for refund processing to happen correctly is that the correct bank account number should be mentioned in your return. If the bank account number mentioned in your return itself is incorrect, you will have trouble with getting the refund into your bank account. After that, you have to make sure that your bank account is pre-validated on the income tax portal. On the income tax portal, you have an option to pre-validate the bank account, which is essentially validate that, yes, this is my bank account, and this can be done by OTPs which are sent to the email ID and the mobile number linked to that bank account. So you have to make sure that whichever is the bank account that you are opting for getting the refund is pre-validated. We have experienced that bank accounts which are already pre-validated, in which refunds have been received in the past, are still showing as not validated in the current year. That happens. In the last 2 years, we have seen this happen, that we have received refund in that same bank account in the earlier year. The client has received refund. But in the current year, it again shows there is a refund failure because of bank validation. You do not really have a choice. You have to do that validation again to get the refund and put in a refund reissue request so that the refund is processed correctly. Even PAN should be updated with the bank account correctly. If there is any mismatch in the PAN, the refund processing will fail. It will not go to your bank account. Here again, our experience has been PAN is often correctly updated with the bank account, because banks obviously, in most cases, take your PAN details and KYC details and verify them. But still, we get this error through the portal. The simple resolution to that is we ask the bank account to once again update the PAN. And after that is done, we put a refund reissue request and it goes through. So it is probably some technical error where data that is existing is not captured correctly. Once it is again updated, it gets captured correctly. Revised returns, updated returns, and rectification. Revised returns, as we all understand, the provision says if there is an error or an omission in a return, it has to be revised. It can be revised rather, not has to be, and it will replace the original return. What happens in recent years is a lot of information on high value transactions was earlier missed out when filing the original return, which is now being captured in the AIS that we spoke about. Purchase sale of mutual funds, share securities, FDs which are placed, purchase sale of property, all of that is now reflecting in the AIS. So now there is less scope for such high value transactions, but even after that, In several cases, what happens is the return income may be lower for XYZ reasons. A lot of it may be exempt income, or the high value transactions that the client has undertaken may be out of earlier savings, whatever be the reason. But there can be high value transactions which do not match with the income for which the return has been filed, and therefore the client can get a notice, not a notice, so to say, an email and a SMS that there are high value transactions in your account, please check. This typically happens close to the due date of filing the revised return. In such a situation, there can be scenarios where you come across some added information which was not captured in the original return, and it gives you an opportunity to file the revised return so that everything is captured. The form of the revised return can be different from the original return. So when you filed the original return, you didn't have any capital gain information. So you filed ITR1, but then you came to know, okay, the assessee has some capital gain transactions, some income from capital gains, and therefore ITR1 is not the correct form. ITR2 should be filed. That is possible when you revise the return. The due date for filing the revised return, or the last date for filing the revised return, is 31st December after the end of the financial year. If you have, after 31st December, if you come across something because of which you need to change information in the return, then the only option you might have is to go for updated return. We'll come to updated return in a bit. Then rectification requests. Online rectification requests are only allowed for orders which are passed by the CPC. If the orders have been passed by the jurisdictional officer, then you cannot put in an online rectification request. 3 types of rectification requests are possible, which is reprocessing of the existing return. Here you do not change any data, but if you realize that the CPC has not captured certain information, not processed certain information correctly, then you put a reprocessing request. It gets it can get reprocessed with the correct information, and the demand can go away. Then the other 2 options are, either there is a mismatch in any income information, etc., and therefore you put in a request for data correction. Here you have to file a JSON again as if you're filing the return. You have to prepare the information, whatever was the mismatch, correct that mismatch, generate JSON file, and upload that JSON file as if you're filing a return. But mind you, this is a rectification request. It cannot be used to claim any additional deductions or even to declare any new source of income. You cannot do that under a rectification request. If that is the scenario, you have to either go for a revised return or a updated return. Then if there is any tax credit mismatch also, you have claimed certain TDS which is no longer there in 26AS, or you have not been given credit of certain TDS which is there in your 26AS, then in those cases also you can put in a rectification request. Again, here also you will have to give details of the entire tax credit schedule, the tax schedule of taxes paid, TDS, TCS, everything. Existing, what you had already filed, as well as whatever changes you want to make to it, and then the request will be processed. Updated return has been enabled since last year. New provision introduced last year where 139(8)(a) new subsection was added. This now practically comes into play if you want to file if you have never filed a return and want to file a return with a delay, where your due date for late return, belated return, and revised return has also passed, which is 31st December. Then in that case, you can file an updated return. A maximum time frame of 2 years from the end of the assessment year is available for filing an updated return, which means today, if you want to file an updated return, you can file for assessment year 22-23 and assessment year 21-22. 2 years is possible currently. If the updated return is filed within 12 months of end of the assessment year, then along with the whatever is the tax and the interest liability on that return, you have to pay a 25% additional tax and interest. If it is filed after 12 months of end of the assessment year, but before 2 years, 24 months, then whatever is the tax liability, interest liability on that return, you have to pay 150% of that. You have to pay that tax liability and interest plus additional 50% also has to be paid. All of these payments get covered under new section 140B that was introduced. Normal return, the payment happens under 140A, self-assessment tax, but updated return tax payments happen under 140B. There are certain scenarios where you cannot file an updated return. In the interest of time, I'm not getting into that. There are 2-3 more points that I want to touch upon before I close this session. So certain scenarios where you cannot file an updated return, you will find it under 139(8)(a) also if you read the provision, like reducing tax liability, claiming refund, etc. You cannot use a updated return mechanism for that. That is not why this is introduced. Practically what happens is, if you have missed out some information, the due date for filing revised return, belated return, etc. has passed, but you still want to incorporate that information in the return, you file an updated return. You may not be claiming a loss, you may not be reducing your tax liability, but maybe your tax liability remains the same. There's some in disclosure which you wanted to make, you make it in the updated return, but the tax liability does not change, it remains the same. Now the portal will not allow you to file an updated return if the tax liability is remaining the same. That is, there is no tax payment. So in such scenarios, what we do is we make a nominal tax payment of maybe 10 rupees and still file the updated return to capture that information that has been missed out. CPC and Demand Facilitation Center are 2 points that were also to be covered. This is more of the interface with the CPC. CPC is entirely, as the name itself says, it's a processing center. It's like a BPO sitting somewhere in Bangalore. Of course, started with Bangalore, now sitting across the country. There is no interface. You can only communicate through the portal. Different ways in which you can communicate through the portal are, you can put rectification request or grievances, etc. But often that lack of interface creates a problem because you are not able to resolve certain technical issues also. Of course, CPC regularly comes up with certain seminars and lectures where they interact with taxpayers and gather info, take feedback from them, but that's limited. Ongoing issues are something that you're not able to resolve. Demand Facilitation Center is a new initiative of the tax department that was introduced last year, sometime in August, September, or slightly before that. What it does is it helps taxpayer to resolve outstanding demand. If there is outstanding demand in against your PAN, then they will contact you, send you emails, and then call you also for resolving that demand. The purpose of the Demand Facilitation Center, as the portal itself says, is demand management. They are not meant to replace the AO or the appellate authority. They will not reduce your demand, delete your demand, do revision, rectification, etc. All they can do is help you to understand if that demand is payable. They'll help you to pay the demand. If you think that the demand is not correct and you want to file a rectification request, then they will guide the taxpayer to file the rectification request. So it's more of a BPO again, meant to reduce the outstanding demand through, especially in cases where it is due but payment is pending, or the taxpayer doesn't know how to file a rectification request, etc. Other than that, if there is a demand outstanding in any case, then you can submit a response online. You either accept it or you disagree with it. If you disagree with it, you can give a list of reasons. There are 10, 11 reasons given on the portal. Select from those reasons and give the details. For instance, it is already paid but not captured, you give the challan details, or you filed an appeal, give the appeal details, or you have a rectification in your favor, you give the rectification details, etc. So if there is any outstanding demand, make sure that you've dealt with it. If it remains outstanding for too long, there could be consequences of or action taken to recover that demand. With that, I covered whatever content I had in mind. If I am not sure, because this is a very execution oriented topic, I'm not sure if there are questions. If there are, I'm happy to take them.
We have 2 questions, ma'am.
Yeah, sure, Archana.
Yeah, from Kainas, Mumbai. First question is, professional earning income below rupees 20 lakhs. Would you recommend to opt for presumptive tax or normal tax? If presumptive tax is not opted for, then which ITR is recommended?
Sure. So Kainas, if the professional income is under 20 lakhs, I would typically recommend following presumptive tax. Because one, it is easy to go under presumptive tax, declare income. There are not many details that have to be given. If you are not going under income presumptive tax, you will have to provide entire P&L details and calculate accordingly. Not just that, if you're claiming the profit to be lower than the presumptive tax of 50%, that is limit provided in 44 ADA, then you also become liable to tax audit. So those are aspects you need to consider when you are opting for presumptive tax or otherwise. If you are not falling under if you're falling under presumptive tax, then ITR 4 is the form that applies to you. If you are not falling under presumptive tax, then in that case, ITR 3 will be the form that applies to you.
So second question is, amounts received via inheritance, example 1 crore, is invested by the associates whose annual income is rupees 20 lakh. The inheritance amount is invested in mutual fund. Inheritance amount is tax-free and the invest made is valid. Then how should one reflect it in the ITR to avoid scrutiny?
Actually, there is hardly any way to reflect this in the ITR to avoid scrutiny. So there are certain situations where you can show your assets in the ITR. If your total income exceeds 50 lakhs, then you are supposed to give a list of all the assets you own in the ITR. Other than that, the ITR for somebody who doesn't even have business income does not have any reflection of their balance sheet, of their assets, etc. But if it is inheritance, the best way is, or the suggestion is that you keep all paperwork ready to show that it is inheritance. And if at all any scrutiny comes up, you can always get that scrutiny closed right away by giving the necessary documentation that even though your income was lower, the amount that you have invested is out of inheritance, and the documents relating to inheritance you can produce.
Thank you, ma'am. So we would like to conclude with the first session. On behalf of WYMEC, I would like to thank CA Namrata for enlightening the members on the topic income tax return, intimation, and refund. Thank you, ma'am.
Thank you, Archana.
Yeah, let's move on to the next session on assessment, appeal, and penalty. We have with us CA Saroj V. Manyar as speaker for the next session. Welcome, ma'am. Saroj is a qualified chartered accountant and a rank holder in the final company secretarial examination. She has professional experience of more than 30 years. She was the managing partner of Manyar and Manyar Chartered Accountants prior its merger with CNK and Associates about 15 years back. Currently a partner with CNK and Associates, specializing in the field of direct taxation, representation, and advisory. She also handles the human resource initiatives in the firm. Saroj is actively involved in various professional forums and is a member of the Taxation Committee of the Bombay Chartered Accountants Society and Direct Tax Committee of Western Indian Regional Council of the Institute of Chartered Accountants of India. She has delivered talks on various professional subjects at different forums and has contributed articles to the Economic Times, the Times of India, Outlook Investor, and a column in Mint. Saroj has been honorary treasurer and secretary of Bombay International School. She is currently on the board of INAA, an international association of independent accounting firms. It's a privilege to have the session from you, ma'am. Over to you, ma'am. Over to you, ma'am.
Thank you. Am I audible?
Yes, ma'am.
Yeah. So thank you for the kind words. Thank you for the warm welcome and for having me over. It's a pleasure to always talk to young people, young women, young professionals. It's always a pleasure. The only complaint that I have is I cannot see the people who I'm talking to, and I would have loved to be able to, look at them. I am. Having said that, since we are already a little behind schedule, I'm going to be talking about faceless assessment, and I'm going to be sharing some of the practical instances that we have come across. And we have about 45 minutes, so it's really going to be a very quick capsule, because this is a topic which one can talk about for hours and hours. So just to give a perspective and a background, digitization, and India has been in the forefront of digitization. The tax department has been in the forefront of digitization. In fact, the tax department started its process of digitization way back in 2004-5, where TDS was digitized. So there was this eTDS, and we could actually file the TDS returns online. Then there was company tax returns. There was e-filing from 2006-7, and though initially it was voluntary, it started becoming mandatory. There was e-communications by email, which started from 2015. The tax department has invested heavily in that Project Insight, which is a reporting portal where they get all the data. They get big data, and a lot of data is available there, which they keep on crunching and analyzing, and that's often the basis for the reopening and for scrutinies and for questions and all that. The e-assessment was also introduced, but earlier the e-assessment was, though it was faceless, though it was electronic, it was online, but the jurisdictional assessing officer was the same. So practically what used to happen is we used to upload all the information, but the assessing officer would say, can you please come and, give us printouts and things like that. I guess when COVID happened in 2020, that was perhaps, a trigger, because people could actually not, travel. People were working from home and all that. And it was the absolute opportune time for the faceless assessment. Faceless assessment is completely different from e-assessment, because e-assessment, it is your jurisdictional officer who's doing it, though it is supposed to be virtual, though you're not supposed to physically go submit, you're supposed to, file everything online. But faceless assessment is a completely new ballgame altogether. In fact, I would consider that to be a key milestone, in the government's e-governance program. And when they announced it also, they said that, look, this is one of the largest tax reforms, one of the largest direct tax reforms, with a view to improve the efficiency, transparency, and accountability. They announced that we will be optimally using all technology to obtain all the information, to ask for the information, to review the information, and then to pass the assessment orders. They have used, even for the selection of scrutinies, if there are some seniors in the audience, they would be knowing that in the earlier years, there was a certain methodology of selecting the cases under scrutiny, and often, one would kind of get feelers and indications about the cases being selected under scrutiny. Now it is all completely automated. There are certain risk parameters, there are certain flags in the system because of which the cases are selected. There is complete use of artificial intelligence. And the intent obviously was to completely, minimize the face-to-face interactions between the assessing officer and the assessees. We'll, of course, going forward in the presentation, we'll see that in what cases there is still scrutiny which is in person, but those are like really, really exceptions. Those are more of exceptions than the rule. Also, in the faceless assessments, what the department is trying to do is they are trying to optimally utilize all their resources. So, which means if there is certain kinds of, benefits, say R&D expenses, or certain kind of benefits, or certain kinds of allowances claimed, there would be special technical units looking at it. There would be special verification units looking at it. So they are also kind of specializing, and they are also trying to use the best resources. Like how in a profession, how in our offices we would do, there would be specialists for all things. The tax department is also trying to use. And so a lot of the assessments, especially where there are additions and all, they are being done by a team. There is the tax officer, then there are, special review units and technical units who are looking at that. And the intent is obviously, for ease of business, for reducing the cost of compliance, because India wants to be, or the kind of to attract investments and be a popular destination. We'll of course come across, as we discuss, we will see that whether it has really led to ease of doing business or is it creating problems. Any new initiative obviously will have teething trouble. So that is something which we must always keep in mind. Up to 31st March 21, the faceless assessment scheme was implemented through a notification. Thereafter, when the Taxation Relaxation and Amendment Act, when that came into play, there was a new section introduced, 144B, which has put the entire faceless scheme as part of the act. So there is it is a part of the Income Tax Act and not through the rules or not through the notification. So that gives us, that gives it much more permanency. And looking to the time, I'm not going to go through all the provisions, but 144B section provides for the entire scope and the process and who is going to do it and the methodology, and also the exceptions as to which cases will not be covered under FACE. Now, there are some particular proceedings which are not going to be covered under faceless, and those are the exclusions. So there are the rectification proceedings are excluded. Of course, you have heard in the earlier session that when the CPC is sending an intimation and there are some errors, what is the method to do it, whether it's rectification to the CPC or reprocessing or all of that. But otherwise, if there is the assessment order is passed under faceless, but there are some mistakes or something, there the rectification does not go back to the NFAC. So that will not be covered by the faceless assessment. Similarly, appeal effect to the CIT appeal effect to the ITAT, High Court, Supreme Court orders, there you will again have to go back to your jurisdictional assessing officer. Proceedings under 263, 264 again will not be covered under this particular faceless scheme. Similarly, when we come to 148, one has, about 2 years back when the amendment had come, one had received a lot of notices under section 148. Those notices were issued by the assessing officer. One had to respond to the assessing officer, and either the proceedings would be dropped or the proceedings would be confirmed, and the assessee was asked to file the return pursuant to that. But once the return was filed, the case was the notice under 142(1) would come from the faceless officer. That means from the NFAC, which is your National Faceless Assessment Unit. Similarly, the proceedings before the GAR panel, that is again not covered under faceless. The demand recovery and stay proceedings, when there are earlier years demands and when there are notices for recovery of the demands, that is not covered under faceless. And proceedings before the DRP also are not covered under faceless. Transfer pricing proceedings again are not covered under faceless. TDS proceedings are not covered under faceless. Assessment of non-residents again are in person, not covered by faceless. Final registration of charitable trusts, and this is an important thing because under the new scheme of registration, there were provisional registrations which were granted, and now once the period of provisional registration gets over, one will have to apply for final registration. So that will again not be under faceless, and that will need to go to the jurisdictional officer. Similarly, search cases are not covered under faceless. In addition to search cases, sometimes pursuant to a search, there could be a reopening or reassessment in cases which themselves have not been searched, but pursuant to the statements that they have received during the search, there is a reassessment. And those are assigned to the central charges, so the central circles of the respective jurisdiction. Those cases also are not covered under faceless. They will also be done in person. Then assessments in cases where pendency could not be created on the income tax portal because of technical reason. These are very kind of rare cases or exceptions. Or in case there is a reopening or there is a notice and there is no PAN to a person who does not have a PAN, there again it is in person because there is no portal. I mean, if somebody does not have a PAN, that person is not registered with the income tax portal. So the assessment. And the section itself gives that at the instance of the CBDT, there is a possibility that cases could be done not under faceless, but by the jurisdictional officer. But I have personally yet to come across any instance where the CBDT has assigned any case which was earlier under faceless to the jurisdictional officer. We'll quickly look at what is the structure, mechanism, and the procedure for the faceless. So here we have the taxpayer, the assessee. Then we have the National Faceless Assessment Center. We have the regional faceless assessment centers. There are, I think, about 30 regional faceless assessment centers. Each regional faceless assessment center has assessment units under them, verification units, technical units, and review units. Now, what is the role of each of these units? So the National Faceless Assessment Center is the main body. All the notices, all the faceless scrutiny notices come from the NFAC, which is the National Faceless Assessment Center. That is, headed by the Principal Chief Commissioner of Income Tax located at Delhi. And that is the kind of controlling body. That's the controlling, the center, the main body which controls the entire scheme of faceless assessments. Now, the NFAC assigns the cases. What is the role of the NFAC? It assigns the cases to the assessment unit. It sends the notices to the assessee and it receives the replies from the assessee. It intimates to the assessment unit. The assessment unit is nothing but like the assessing officer who's actually looking at all the data. They intimate to the assessing unit about the failure of the assessee to respond to notice. It allocates the issues cases to the technical unit, verification unit, and review unit. It reviews the draft assessment order and provides the opportunity to the assessee by serving the notice on him. So all the notices are received from there. And as we saw, 144.8 also gives the possibility or gives, the instance where the assessment proceedings can be transferred to the jurisdictional assessing officer with the approval of the CBDT. And once the assessment is complete, once the faceless assessment is complete, the electronic records need to go to your jurisdictional officer. There is, I believe, I understand there's a time lag. Once the assessment is complete, the jurisdictional officer sometimes may not get all the data immediately, but that is the responsibility of the NFAC. Now, when we come to the assessing unit, their responsibility is to perform the function of making the assessment and actually carry out the proceedings, review of the documents, and follow the procedures and all of that. So they initially identify the points or the issues which are material for determining any liability or refund under the Act. They ask, so when we receive a 142.1 notice and thereafter a 143.2 notice, which lists out all the data and all the information that is being sought for, that is done by at the behest of the AU. And once the assessee is furnishing all the documents, often, we would have come across that we have filed certain submissions and given certain data. Based on that data, there is further information sought for. So that is what they carry out. They carry out the review, they verify, they carry out the verification, and then they seek further information. And they are basically responsible for carrying out the assessment. Now, what is the verification unit? Now, verification unit, again, and I had mentioned earlier that the tax department wants the team to be working on an assessment, and which is why it is the team comprising of the assessment unit, the verification unit, and the technical unit and the review unit. The verification unit does the inquiry. If there is any cross verification required, sometimes when data is given, there are 133(6) notices issued, to certain of the suppliers or parties or customers. All that is done by the verification unit. And they would carry out the examination of witnesses, recording statements. And in some cases, if physical verification is required, they would make wherever there are high risk cases and all that, they would make a petition and get that, get the, whatever are the issues, get them physically verified. Similarly, the technical unit provides the technical support, but technical unit is mainly like a backend, So wherever there are some queries that the assessing officer or the assessment unit would have on, say, any legal provisions or accounting or transfer pricing or data analytics, all that is the role of the technical unit, and the technical unit would do that. And the review unit basically would be checking as to whether whenever there is, any addition or any large addition proposed, normally the review unit comes into play, and the review unit will then look at whether the whether all the provisions have been considered, if there are any decisions, whether they have been considered, whether all the points of law have been put in the assessment order so as to strengthen the case of the tax department. So that is basically the role of the review. So when the faceless assessment is happening, whilst we would be interacting or we would be, furnishing or uploading the data on the portal, at the back end, there is a team which is probably working on it, maybe in smaller cases, not the entire team, but often there is a team working on it. Now, when we come to the practical issues, and there are, obviously certain challenges and certain concerns, because faceless assessment, whilst it's been introduced since the last 2-3 years, it's still relatively new, and especially I recollect in year 1, there was a significant amount of struggle in uploading the data, because there were limitations in the data that could be uploaded. There were constraints in the data that could be uploaded. And often there was a huge time lag between uploading the data and the acknowledgement or the receipt of the data by the faceless or by the assessment unit. We were told in the year 1 that after the data is uploaded, it takes them about 10 to 12 hours to actually receive the data. So often in the first year, when say the timeline for submitting the data was, say today is 16th of May, say the timeline was 16th of May, 4 p.m. And one would have uploaded the data at 3 p.m. But on the next day, one has got the assessment order saying that no data has been submitted and no details have been filed. So we understand that it used to take a long time for them to actually receive the data, though the data was uploaded by the assessee. And a number of decisions also are there where the submissions or the opportunity or non-acknowledgement or not looking at the submissions has been alleged by the assessees, and often the cases have been set aside and all that. I believe a number of those challenges have been resolved. I would not say completely resolved, but minimized. A number of those challenges have been minimized. However, having said that, it is very important for us to take care of a number of things. firstly, when we are uploading the data, so earlier when the data was being uploaded, there was a requirement of digital signature, and there was a requirement of, if it was going on the letterhead of the authorized representative, there was a requirement for the letter of authority and all that. Since last year, any data which is going to be uploaded through the portal, and the data has to be uploaded through the portal, that data is deemed to be electronically verified. It is deemed to be filed under EVC, the electronic verification, or it is deemed to be digitally signed. The moment it is uploaded through the portal, it is deemed to be digitally signed. So at least that is taken care of. One very important thing is, if there is any communication that the assessee has received from the NFAC, and that communication or that document does not have a DIN. DIN is a document identification number. And if you see any notices on top, only it says DIN number so and so. If that DIN number is not there, then that document is invalid. So that is something which has to be kept in mind. Because whatever are the documents which are sent by NFAC, whether the digital signature is there or no, as long as there is a DIN, that is, that is authentication enough. Now, practically what happens is, often, especially when the time barring deadline is nearing, often there are notices that one sees on the portal, but one does not get the, whilst the registered email ID is already on record, one does not get the notices. It has happened in the past, it has happened a number of times. Maybe either the notices go into spam, or maybe the client has missed that notice or not seen it or whatever. But what the department, or what the faceless assessment scheme says is, every notice, the moment it is authenticated copy with a DIN number is placed in the assessee's registered account, is deemed to have been served on the assessee. And it is deemed to have been served the moment it is kept on the portal, the moment it is available on the portal. So it is very important for us to alert our clients, to alert the assessees that please keep on looking regularly at the portal. Alternatively, we could do that for them. We could look at, especially when the timeline is coming, it is very important to keep on checking the portal on a regular basis. It could be once every 2 days. Initially, it could be once a week, but when the deadline is there and you know that the assessment is pending, the assessment is ongoing, it is very important to keep that in mind. So whilst the SMSs do come, whilst the emails do come, there have been a number of instances in the past where the assessees have not either received it or not, shared it. So that is something which needs to be kept. The other practical thing is, when the assessee is filing the response through the registered account, through the by logging in into the portal, when you get the acknowledgement, you need to see that the acknowledgement should have that hash result. And once that is there, that is authentic, that is proof that it has been filed. Yeah, that is proof that the notice has been referred to. Whilst I have mentioned that later, one very important thing is, especially when the deadline is nearing and the details are being filed and some further information is yet to be filed, when one is responding, one should not file it as a complete response. One should always leave that option open, and one should always file it as a partial response, because one has come across instances where, whilst you want to still file some more data, because you have filed it as a complete response, the window is closed. And once the window is closed, you will receive the assessment order without you having got the time or the opportunity to file the balance details. So a very important practical thing is, whenever the last set of submissions is being made and you want to make further submissions, either some further data is awaited, please file it as a partial response and not as a full response. coming to other practical issues, when we say registered email address, what happens is there are different sets of registered email address on the income tax portal. Because when one has filed for PAN, at that point of time, there may have been a different email address. When one has filed the return, there may be a different registered email address. In other proceedings, there could be different registered email addresses. And often we have always suggested or advised clients that when you are having an email address of a particular person, you should not have an email address of abc@xyz.com. You should have taxmanager@xyz.com, because even if there is a change, and over the years, there would be changes in every organization. So even if there is a change, ABC has left and in his place DEF has come, if the email address says taxmanager@xyz.com, that will be a permanent email address. So that is something which, has been working for us. We have tried to do that in a number of cases. Because often, the email address is taken from the return of income. The proceedings may happen later, especially if there is a reassessment case or anything. And the email address in the return would be something which is, 5, 7, 8 years old. So that is another challenge. So whilst the definition of registered email address as per, the rules and all that, they have given a whole list of email addresses. It says email address available in the electronic filing portal, available in the last income tax return, available in the PAN database, email ID which is linked with the Aadhaar. If the assessee is a company, the email ID of the company is visible on the MCA website. So MCA website again would have perhaps the email ID of the company secretary and any other email ID made available by the addressee to the income tax authority. So these are the things, these are the practical issues which we need to keep in mind so that one doesn't miss out on any notices. The registered mobile number of the assessee means, again, the mobile number there again it's a practical challenge if there is a change in the people who were handling the tax matters or the compliance matters. But that is something which the moment there is a change, we would normally advise the assessee, please get it changed in your PAN records, please get it changed in the income tax portal, please get it changed at least in the ongoing returns. Please ensure that one does not copy the last year's phone numbers and all that. So that is something which needs to be kept in mind. So this is the registered mobile number. Registered account, of course, will be the same account. And the real-time alert means any communication by way of the SMS or mobile app or registered email app. So communication, these are the things we need to keep in mind. We need to ensure that everything is updated. The moment there is a change, that needs to be updated. And this is something which we need to explain the importance of that to the assessee. Often this is not the responsibility of the professional, but when we have clients, it is important to explain to them that this is critical, because if there is a miss in this, it could have very serious consequences. We saw what is the time and place of dispatch of the notice. The moment the notice reaches the portal, that is the deemed date of dispatch. This is again, we have discussed this. There is no, Now, one very important thing is, whilst there is no provision of personal or physical hearing during the case of faceless proceeding, there is a concept of video conferencing. And again, to share a couple of personal experiences, often the matters may not be that complicated. But because the data is so convoluted or so confusing, or the tax department has kind of mixed up data of 2-3 assessees, often when the tax department gets data from outside sources, the outside sources may have given some information which is inaccurate, or which is, because of some wrong numbers. We've had instances where the PAN number quoted by the bank was incorrect, and so one of our clients got a notice. Now that client had got nothing to do with that bank or nothing to do with that investment, but just because the PAN number was incorrect, a notice was received. So those are the things we have to keep in mind. Often when you have, our experience has been often when you have applied for a video conferencing and one has got an opportunity and one is able to very clearly explain the facts, one is able to clearly, substantiate, maybe show on the screen the relevant documents and explain the facts, the assessing officers have understood. Of course, there have been instances where despite the video conference, there have been adverse orders. But often one sees that video conference is an opportunity that the assessee gets to actually explain the case orally. Because whilst you may write, you may make submissions, you may make pages and pages, and you may have lot of documentation, we need to remember or we need to understand that the tax officer sitting in one corner, he does not have the background, he does not have the time to go through the 100 pages that you have submitted, and he does not have time to kind of cross-check and analyze what you are trying to say. So often the video conferencing is an opportunity to explain your case. So wherever one has received a show cause notice, one must avail of the opportunity of video conference to try and see if you are able to explain the case and convince the assessing officer on merits as to the justification of the stand that you would want to take. And now internally, the department has been given instructions that whenever an assessee is requesting for video conferencing, that should not be denied and that opportunity should be given. Now, the video conferencing comes at the last minute. So which means that only when the case is getting time barred, one receives the show cause notice, show cause come draft assessment order. And then one would have to request by video conferencing, not via the letter, but by putting that there is on the portal, there is a tab for requesting video conferencing. So you need to click on that tab and make the request accordingly. Just by writing in the letter, that is not sufficient. Again, our experience has been that once we have requested for video conferencing, we normally get the hearing in the next 2-3 days. Theoretically, there is also if it is not convenient and one would want to seek an adjournment, one can always seek a short adjournment of a day or two. But if possible, one must take the opportunity and appear for the hearing on that day. Again, when about 2 years back, there were a lot of technical challenges. We had instances where the video conference was granted to us, but we could not log in, or we could log in and the department could not hear us. So there were those kind of challenges also in the portal, but I think now by and large, those challenges have been sorted out by the department. Now, when you appear for the video conference, normally they expect our video to be on and their video is normally not on. Sometimes we have come across instances where the department also keeps their video on, but our video is on. And if we want to show certain data, if we want to, keep certain data, we could keep it and then share our screen. And normally, when we appear for the video conferencing, we would normally keep our identification and our letter of authority ready. Of course, if the letter of authority is already on the portal, then it is not required. But we would normally first, give our introduction and then introduce the assessee, give the introduction about the assessee and the business, and then talk about the issues. And then thereafter argue the case. And normally one gets a time of, depending on what the issues are, anything between 25-30 minutes to 45 minutes, because normally they also have back-to-back VCs. So they normally give about half an hour, but sometimes they also extend at your request. So that is something which needs to be kept in mind. And normally the VC link and the password comes in about on the same day in the morning it comes. Often one can join the VC, the assessee can also join, and the authorized representative can also join. That is also possible. The authorized representation, also possible. So more than one login can be done. That is normally not a problem. That was that's been our experience. And as far as the submissions or presentations are there, at least in the recent experiences, they are able to access whatever documents we are referring to. Now, a couple of other, issues about how best to prepare for. How much time do we have? Do we have 15-20 minutes, or how much more time? Archana or Mamta?
Ma'am, we can continue for 10 to 15 minutes.
For about 15 minutes. Okay. So on the preparedness, it is about 6, so till 6:15. Okay. So it's very important to, respond to the notices on the timely basis. Now, often when the scrutiny, when the assessment is selected for scrutiny, initially it takes time for the notice to come, and often we have seen that the assessees may not even be aware that a notice is there on the portal. Each professional or each entity will need to set up a process to regularly look at the portal and to ensure that no notice is being missed. It's a very basic and it's a very fundamental thing, but it's a process which needs to be set up. One obviously needs to ensure that the registered email ID, mobile number, all that is updated. One should ensure that the secondary contact details are updated, because often what happens is there is a primary contact detail, but the secondary contact detail is not there. Now, because of technology, the tax department is very liberal in sending notices and mails to as many email IDs that is there. So that should not be a problem. One should check the portal at regular intervals. One should add and update the authorized representative so that the response to the notices can be made. And obviously ensure that the response is filed well in time. Whenever there is a scrutiny and there have been past additions or past, significant transactions or any new transactions during the year, obviously it is advisable to keep the assessee apprised and to keep all the documents ready. So, for example, things like angel tax, things like, any significant deductions which are claimed, things like any, 15 CA, 15 CB, all these are often, reasons or often details which are always sought for. If there are any, M&A transactions during the year, any restructuring done during the year, any significant introduction of, say, share capital. So one needs to keep all the documentation ready. One knows, by and large, one knows what are the recurring issues, what are the large issues. So let us not wait for the department to ask. Let us at least have that preparedness ready, so that when the notices come, one is able to file within time. Now, how does one make the submissions? Because earlier, when there was in-person hearing, one could actually go explain the background of the case, explain what the assessee is doing, and explain the issues, the challenges, the business considerations, and all of that. Now, everything has to go in writing. So it's very important to be very, very cryptic, very clear, but also ensure that everything is on record. We also need to remember one thing, that This is, in case there is any litigation, it is going to be very important that your basic data that is there, that is the data which is reliable, and that is the data on which you can rely. So it's very important to ensure that your data that is being submitted is cryptic, it's crystal clear, and it's adequate, it's complete in all respects. From a combination of oral and written skills, now the written skills have taken precedence. It's more important to ensure that your drafting skills are they are honed up, and your drafting skills are kind of impeccable and clear. Because whilst for you, or for the professionals, or for the assessees, they know the facts of the case. We have to always remember that the person who's looking at it does not know the background, does not know the facts of the case. So it's always good to put in a para about the background of the assessee. It's always good to put in a para about the business of the assessee. It's always good to put in certain things which give a comfort, and which give a comfort to the person reading, that you are giving all the data, you're crystal clear, you're giving all the data. Having said that, one also needs to look at the data which is meaningful. I mean, it cannot be a lot of repetitive data, or it cannot be a lot of data which has got no relevance to the questions asked. So one needs to be clear in whatever data is being given. In fact, we have not really very often, but there have been times where we have put in some process flow. We have put in a simple kind of chart of flow, because sometimes when they want to understand, say something on the manufacturing process, or something on the method of inventory, or something, one has actually put in a process flow. Okay, this is how we are doing that particular transaction, or this is how the assessee is maintaining the documentation or the record. So sometimes, a flow chart or a diagram or something can also help. Use of Excel sheets, obviously, to provide large data. Normally, whenever there is large data, although there is a covering letter which is giving all the details as per the notice, we still make like an index, a paper book kind of index with a pagination. These kind of things really help. Then wherever there are agreements, etc., normally what we have done is we have always produced only the relevant extracts of the agreements, because an agreement could be 150 pages. You may not need to give the entire agreement. You could give the first 1-2 pages, and then you could give the agreement which has got the terms which are asked for by the tax department, or you could give the financial numbers which are there. So that is another thing which can be done to minimize the size. Again, numbering, cross-referencing, all those things really help. Before, in fact, starting to prepare the data, it's good to, if one can conceptualize what is the submissions and what is the flow of the submissions. And often what we have done is, whilst the notice may be having about 50 points, and today in the first tranche, the assessee is ready only with, say, 30 points. One has still gone as per the flow of the notice. And wherever it is pending, it is mentioned that way, that this will be given in the next set of submissions, so that they are also able to track all the data and track all the information. The submission should be specific. They should be related to the points raised in the questionnaire. Then again, the key issues, that can be raised would be major expenses. See, often in recent times, things like TDS, things like purchase of immovable property, all your sections of your 56, capital gains again. Now, if we are looking at individuals, then it is more on the investment side and the capital gains and all of that. If it is corporates, they would always look at what are the disallowances in the earlier years, and what is the resolution to those disallowances. Whenever there are significant related party payments, those are things which are sought for. So one will need to prepare all those details and collate, compile them, and all that. Often we have told the clients that when the tax audit report is being finalized, please collate the details in such a manner that if there is a tax scrutiny, you do not need to rework on this data. Now, on what basis do these, is the information sought for? Typically, the tax department looks at the Form 26 AS, it looks at the annual in the AIS and the TIS, which Namrata, I think, has discussed in detail. The Insight portal, the MCA website. There is a lot of data they get from investigation wing. There's a lot of data they get from the customs and from that ICE gate and from GST returns, TCS statements, from the registrar, the stamp duty, and a lot of investment related data. So there also, and now the tax audit report also needs to do the reconciliation between, needs to give all the data of GST. So one will automatically need to reconcile the GST data and the data that one is giving in the tax audit report. So those are things which need to be reconciled so that there are no mismatches, because those mismatches create red flags and lead to scrutinies. Similarly, the value of property the stamp duty value of the property and the transaction value. Those are again red flags. One knows that if there is a mismatch in that, there could be tax scrutinies and questions. Similarly, any foreign remittances, that is again, when there are large foreign remittances, especially there is no withholding tax on those remittances, that's one reason for a red flag and for scrutiny. And AIS and TIS, because the tax department is in receipt of a lot of information. One more practical thing. One is I mentioned earlier that you must file as part submission in case, especially when you have received kind of the final notice towards the fag end of the deadline of the timeline where the scrutinies have to be finished. You must file as part submission, because if you file as full submission, you lose your opportunity and the window gets closed. And wherever you have received a 143(1)(a) and some adjustment is made, which is disputed, which you are not accepting and which needs to be rectified, there you need to constantly follow up and get it rectified. Otherwise, what happens is, even if that adjustment is not made in your 143(3), but when the computation happens, the computation of tax happens, they start with the income of 143(1)(a). So that's another practical challenge which you need to handle. We discussed time is very short, so you need to be prepared. Individuals can keep their bank statements and bank summaries, investment proofs, donation proofs, and all that ready. Quickly, do's and don'ts. We have discussed this, that registered email ID, mobile numbers should be updated. Check the portal. I think this is very critical. Check the portal at regular intervals. Sorry. Yeah, check the portal. For non-individual taxpayers, avoid using of individual IDs, use functional IDs. Identify recurring issues, keep copies of, so this we have discussed broadly. And try not to take too many adjournments, because normally, when you take adjournments, that itself is again a red flag for the tax department, that they feel that data is not forthcoming and the assessee is not giving all the data. So it's always better to give all the submissions at the first go. We have seen most of this. The AIS and TIS, again, practically one more thing. AIS, TIS, you must ask the assessee should be regularly looking at it. And if there is some data which is incorrect, which is not pertaining to them, get that rectified at the earliest. Often we have seen, especially for if we look at individuals and there are joint account holders, the same transaction comes in both the accounts. And there immediately, one needs to say that this does not belong to me or this belongs to me only as a joint holder. These are things which need to be considered and which need to get rectified at the earliest, so that when there is a time, when the time for scrutiny comes or when the time for selection of scrutiny comes and filing the return and there's a mismatch, because of this reason, the case should not come under scrutiny. So that's something which we need to apprise our clients on that. Faceless appeal, I'll just take 2-3 minutes. Faceless appeal is again the CIT appeals. One is aware that since the last about 4-5 years, hardly any CIT appeal orders have been coming, and there's a huge number of pendency at the CIT appeals level. In fact, our experience has been that wherever we have made these submissions, we've got notices, same notice 3-4 times, we've again made submissions, but very few CIT appeal orders have come. And we have seen in a couple of cases where they've sought adjournment or they are not giving the data or submissions, the CIT appeals have passed ex parte orders. And I have heard that this is a rampant practice. So one needs to be mindful, one needs to ensure that submissions are made on time. In fact, nowadays, when one files a CIT appeal, immediately on the next day, one gets a notice saying that the window is open, the window is enabled. So that means from day 2 onwards, you can start filing your submissions. Now, often if there are instances where you may want to file some additional evidence or when you need to, file some additional data, one should do that at the earliest. So CIT also now is faceless, but a couple of other things we need to keep in mind is, if there is any additional evidence to be filed or if additional grounds are to be filed, there is a special, there's a procedure to do that. And once you file that, the CIT appeal in turn will send it to the jurisdictional assessing officer to review that data. And you may then get a notice from the jurisdictional officer for reviewing of a cross verification of that data. Whilst earlier also the CIT appeals had enhancement powers, now there is a specific provision which grants them enhancement powers. So that is also something one will need to be mindful of when you make the submissions. Now, stay of demand, whilst typically for stay of demand, the CIT, one obviously after going to the assessing officer, one goes to the commissioner and then one goes to the exemptions. One goes to the tribunal, but there is a possibility of the CIT, of going to the CIT appeals also. So one can file a request for stay of demand to the CIT appeal also. If 20% payment has been made, then the balance demand is automatically stayed. But in large cases, it may be possible that the assessee would not want to make even 20% payment and request for a full stay. In that case, one may look at if the assessing officer is not in a position to grant it, this is also a possibility. And since the window is enabled, if you would like an early hearing, one can always make a request through that window. But our experience again is that has not been adhered to. We have not really, we have started receiving some orders, but not too many. Faceless penalty, again, this is again the, a new thing where faceless penalty is also, where penalty proceedings are also under the faceless scheme. And there also there is a National Faceless Penalty Center and regional center and units and review units. It's on very similar lines as the faceless assessments. And obviously the submissions have to be given to the submissions have to be made online. We'll have to keep everything in mind. We'll have to keep in mind that the facts have to be given from scratch and the justification for non-levy of penalty, whether it is for underreporting or misreporting, will need to. And drafting skills obviously have to, come to the forefront, and clarity needs to be given. One needs to be crisp and clear. One of the things that has worked for us in many cases is giving an executive summary. Normally, one uses all these techniques when one is writing large reports or large, documents. But here also often, one could just summarize, and then give the detailed justification of all the arguments, especially when one is relying on a number of case laws and all that. So one can do an executive summary and then look at all the arguments. So I think that's it. From my end, any questions, I'll be happy to answer.
Good evening, ma'am. There is a query. I'll read it out for you.
Yeah.
Amounts received via inheritance. Example: 1 crore is invested by the assessee, whose income is 20 lakhs per year. The inheritance amount is received in mutual funds. Inheritance amount is tax-free, and the investment made is valid. Then how should one reflect it in ITR to avoid the scrutiny?
See, in the ITR, unless because if the income is above 50 lakhs, you need to give details of all your assets and liabilities. If the income is below 50 lakhs, you can give details only of immovable property and of private limited shares in unlisted companies or any foreign assets. Other than that, there is no place to really give any data. If it is immobile property, if it is foreign assets, if it is unlisted company shares, obviously you need to give that data. But otherwise, you need to keep the documentation ready. And see, the question is, if the income is 20 lakhs, but you still have so much assets and you show it in your return, there can still be a question. But wherever there is a bona fide case and wherever there is a proper explanation of it, at least in so many years of my practice, I have found that there could be questions, but if you're really able to justify, and especially at individual cases, then the assessing officers do accept it. Unless, you're not in a position to justify. Suppose the inheritance is not from an immediate relative, then obviously the tax department, it's a red flag. But if the inheritance is from a relative, that relative is filing the returns and all that, then when it's a bona fide case, I mean, my experience has been that by and large, the tax department accepts.
Okay, thank you so much, ma'am. Now I would like to propose a vote of thanks. Thank you so much, Saroj Maniar ma'am, for such a detailed insight on assessment, appeals, penalties, and very rightly said, the drafting skills for making the presentations and virtual hearings, and also with the trending topic, faceless appeals. Thank you so much, ma'am, for being with us. Thank you.
Thank you. Thank you.
So I